Gold is bullish on all time frames, but even the strongest bull runs pause to catch their breath. After reaching a new all-time high of $5,627 on 29th January, gold underwent a sharp two-day correction of $1,281 on 30th January and 2nd February, finding its structural low at $4,423. Since then, buyers have been recovering that lost ground, but the recovery has stalled at the psychological round number of $5,000. The key question is whether this pause is temporary consolidation before a push to new highs, or whether the sharp January correction has more to say. In today's gold technical analysis video, we examine the dominant range set by the 29th January all-time high at $5,627 and the 2nd February structural low at $4,423, the range that continues to contain all price action. We define the precise price zones gold is currently negotiating, overlay the Fibonacci resistance and support zones that frame the upside and downside targets, and identify what must happen for gold to resume its bull run or signal that further downside correction is ahead. By the end of this analysis, you will know exactly which price zones gold is working within right now, where the key structural levels sit, and the precise conditions that confirm whether gold is positioning for new all-time highs or testing the resolve of buyers at the $5,000 level. If you seriously trade or invest in gold, these are the zones you need to be watching. Welcome back. We are Bitcoin Capital Gold, built for serious traders and investors who want structured technical analysis and capital discipline across Bitcoin and gold. Every day, we answer 5 structural questions. Are gold's timeframes aligned? Where are gold's key price zones? What is gold's volatility signaling? What macro events could affect gold prices? And what must change to shift gold's structure? The timeframes are the skeleton of our price action. They provide the framework we hang our analysis on. For gold, right now, the picture is unambiguous. The yearly chart is bullish with the swing direction currently up. The monthly chart is bullish with the swing direction currently up. The weekly chart is bullish with the swing direction currently up. All 3 timeframes are aligned, and all 3 are pointing in the same direction. That alignment is the foundation of the bull case. It tells us the dominant trend is intact and that buyers have the wind behind them across every timeframe we track. However, timeframe alignment does not mean price moves in a straight line. Current price sits at the psychological round number of $5,000. The structural low set on 2nd February at $4,423 remains the key support anchor of this entire structure. A weekly or monthly close below that level would represent a genuine structural change, the first meaningful challenge to the bullish timeframe alignment. Until that happens, the line of least resistance remains higher. But whilst all timeframes are up, gold is currently in the grip of short-term indecision, and that indecision is happening at a psychologically significant price. Very similar to Bitcoin, gold is contained within just a few large dominant bars that overshadow all subsequent price action. The dominant range was set in 2 extraordinary sessions. On 29th January, relentless buying drove gold to its all-time high of $5,627, a record that felt unstoppable in the moment. In that same session, gold produced a range of $501, closing well below the peak at $5,355, the first warning sign that sellers were present. The 30th January extended that punishment with a range of $780, closing at $4,745. 2 days, a combined correction of $1,281, and by 2nd February, gold had found its structural floor at $4,423. Every session since has traded within those boundaries. The dominant range is defined by the 29th January high at $5,627 and the 2nd February low at $4,423. That is the cage gold is operating within. The midpoint of that dominant range sits precisely at $5,025, almost exactly the psychological $5,000 level where price is currently pausing. That is not a coincidence. It is the market finding its equilibrium. Above $5,025, buyers are in control of the dominant range. Below it, sellers begin to assert themselves. Friday's close at $5,172 places gold above that equilibrium. Buyers currently hold the balance of power within the dominant range. Since the 2nd February structural low, buyers have been constructing a recovery, and the sequence of structural lows tells the story of that recovery with precision. The first defense came at $4,423 on 2nd February. Buyers then held at $4,670 on 6th February, a higher low. The 17th February held at $4,854, higher again, and the 3rd March held at $5,005, the most recent structural low, sitting just above the psychological $5,000 level. Each successive low is higher than the last, buyers defending at progressively higher prices. That is a textbook sequence of structural recovery within the dominant range. The structural highs mirror that recovery. From the all-time high at $5,627, the week of 23rd February pushed to $5,299, and the 2nd March high reached $5,434, each week attempting to reclaim more of the dominant range. Since the 3rd March structural low of $5,005, all of gold's price action is now contained within the range from $5,627 to $5,005. That tighter range, with a midpoint of $5,316, is the more immediate framework buyers are working within right now. Using the swings within the dominant range, we are able to establish our Fibonacci price zones, landmark levels that mark where current price activity is most likely to meet resistance or find support. On the upside, our Fibonacci resistance zone sits between $5,342 and $5,348. This is not a structural level in itself. It is a zone that tells us where sellers are most likely to show up as buyers push higher. Friday's close at $5,172 sits $170 below that zone. It has not been tested. That is the upside landmark buyers need to clear to signal a serious assault on the all-time high. On the downside, our Fibonacci support zone sits between $5,963 and $5,991, both levels just below the psychological $5,000 level. Again, this is a landmark zone rather than a structural anchor. It marks where buyers are most likely to defend if price pushes lower. The 3rd March structural low of $5,005 tested this area and held. A close below $5,963 would be a meaningful signal that selling pressure is overcoming buyer defense at this zone and would shift focus to the structural low of $4,423 as the next significant reference point. Now, here's the detail in the monthly data that most gold watchers are not talking about. Volatility gives us an under-the-hood look at the energy behind gold's price action, and the story it is telling right now is one of compression after an extraordinary event. The weekly ranges make this visible. The ATH week of 26th January produced a range of $926. The following week, containing the structural low, produced a range of $691. Since then, weekly ranges have contracted sharply. Week 8 at $277, Week 9 at $188, Week 10 at $423. Contracting ranges after a large event tell us the market is compressing, building energy for the next directional move. The expansion, when it comes, will signal which way gold has chosen. The monthly open-to-close data contains the most important signal in today's analysis. Gold has produced 12 consecutive bullish monthly closes, every month from February 2025 through to February 2026, closed above its open. That is an extraordinary, unrelenting run of buying pressure. But March 2026 is currently tracking bearish, opening at $5,376 and closing Friday at $5,172, a deficit of $197. It's early in the month and this can change, but it is the first early clue that we could see gold test that $5,000 support and potentially break lower. We do not anticipate, but we note the signal and watch closely. From a macro perspective, 3 markets are shaping the environment gold is operating in. The US dollar index made 2 strong pushes above the $98 resistance level on 2nd and 4th March, but has since stalled. A stronger dollar is historically a headwind for gold. However, a dollar that breaks resistance and then fails to extend is not a dollar in sustained rally mode. If the dollar rolls over from $98, that removes a headwind and strengthens the case for gold to resume its move toward the all-time high. Crude oil is a development that directly supports the gold narrative. The Straits of Hormuz disruption is pushing crude oil prices sharply higher, blocking oil transportation globally. Rising crude in the context of geopolitical tension in Ukraine and Iran is historically supportive of gold as a safe haven store of wealth. Institutional capital that moves into gold during periods of geopolitical risk does not move quickly. If this tension persists, it provides a macro tailwind for gold that is independent of the technical picture. The Nasdaq remains range-bound between $24,500 and $25,500, but Friday's session produced a strong bearish bar pushing to a low of $24,601. If equities break lower, institutional capital has historically rotated toward gold as a portfolio hedge. A weakening Nasdaq at a time of geopolitical tension is potentially a dual tailwind for gold. Here is what the complete picture is telling us. Gold's timeframes are all aligned bullish, yearly, monthly, and weekly all pointing up. The dominant range from the 29th January all-time high at $5,627 to the 2nd February structural low at $4,423 continues to contain all price action. Buyers have constructed a sequence of higher structural lows within that range, and Friday's close at $5,172 sits above the dominant range equilibrium at $5,025. The macro environment, geopolitical tension, rising crude oil, and a stalling dollar provides an external tailwind. The line of least resistance remains higher. What must change for the structural picture to shift? A genuine structural change in gold is defined by the yearly, monthly, and weekly highs and lows, not by individual Fibonacci zones. Those zones are landmarks that tell us where price activity is concentrated and where directional decisions are most likely to be made. For a true structural shift to the upside, gold needs to produce a new yearly or monthly high above $5,627 on a closing basis. For a structural shift to the downside, a weekly or monthly close below the 2nd February structural low at $4,423 would redefine this market entirely. Our Fibonacci zones will tell us which way gold is going to swing between those structural anchors. For now, the evidence favors patience. We let price action play out and give us clear directional confirmation. We monitor, we do not anticipate. Discipline over prediction. Every day at 7 a.m. EST, we publish institutional-grade technical analysis on both gold and Bitcoin. There's a reason we cover these two assets together. The conversation between them is one of the most important in modern capital allocation. Gold is asserting itself as the defining store of wealth of our era, reaching all-time highs against a backdrop of war, inflation, and institutional demand. Bitcoin is simultaneously rewriting its own narrative, no longer simply a speculative asset, but one that serious portfolio managers are beginning to position alongside gold. Whether your approach is conservative, balanced, or aggressive, understanding how these two assets interact is no longer optional. This channel is built to help you think through that decision with structure and discipline. If you found this video useful, consider liking and subscribing so you don't miss tomorrow's video. What do you think of the levels we gave? Do you agree? Do you have your own levels you're watching? We'd love you to share your thoughts. Comment below so we can all discuss. Bitcoin and gold are shaping the financial landscape of the future. This is the channel that discusses this maturing relationship.